Hello, everyone. Thank you for attending. Today, we are going to talk about the Redfin's market data, real-time data for August 2022 on the Phoenix, Arizona housing market. Welcome again. Thanks for attending. My name is SeeWing Yee from the Yee Real Estate Network. And I have the ability over the past 20 years to understand the national real estate market. What does that mean? That means that we have taken our real estate investors over almost 20 years in different markets in the US, around 30 markets, including Phoenix, Arizona at one time, by the way. And our investors have achieved positive cash flow in many great markets over the years. And today we are focusing in the market regions of South and Southeast. But I would love to talk about Phoenix because at one time, a mere 6 to 8 years ago, we promoted our single-family home residential investing in the Phoenix market because at that time the numbers make sense. We'll discuss a little bit more about that toward the back end of this presentation. So let's go over what's going on today in the red hot Phoenix market. So let me go ahead and share my screen. So this is a Redfin weekly housing market data. Now let's look at the big picture. The big picture is before the pandemic, the median price of a single family home in the Phoenix metro is $281,000. All right, keep that in mind. Now, 2.5, 3 years later, let's look at the peak. Last month, the week ending June of 2022, the new median sales price is a whopping $487,000. From a little bit less than 3 years, from 282 to 487. So you do the math, right? It does not take a mathematical genius to divide one number by the other, and we have almost achieved 100% appreciation growth, equity growth in a very short period of time here in Phoenix, Arizona. So just so you know, there are like top 10 cities that have achieved just skyrocketing appreciation during the pandemic, and Phoenix is one of them. Boise is another one. Austin, Texas is another one. Tampa, Miami, just to name a few. I'm not going to go over the top 10 list. You have other data available. So the question is, will the Phoenix market crash and burn like the Top Gun movie by Tom Cruise, for example? Have you remember that scene, crash and burn? Well, let's go back. No, the past history is not an indication of a current situation, but for those of you that remember, the 2008 real estate market crash occurred nationwide, and the Phoenix area was one of the areas that crashed back in the housing market. But let's compare briefly what happened in 2008. 2008, we were subject to the subprime mortgage lending standard, where anybody and their brother and their sister and a hairdresser in Las Vegas or Phoenix can qualify for a mortgage without any kind of documentation, no doubt loan, liar loan, or whatever. So that pretty much initiated the housing crash back in 2008. At that time, there was excess inventory. Anybody can qualify for a mortgage. That's the main reason for the crash. However, today's market, we have learned a lesson with the passage of the Dodd-Frank Act. The lending standards have become extremely much stricter. The last 10 years, only very high qualified borrowers can qualify to get a mortgage with most likely at least 10 to 20% down, right? So, and with the skyrocketing prices all over the country during the pandemic, most homeowners and investors they have massive amount of equity. As a matter of fact, 40% of the houses owned in the U.S. right now are free of mortgages. They are debt free. The remaining 60% of people that have mortgages, they have achieved massive amount of equity. And most important of all, they have locked in their interest rate at less than 4% because they purchased at a low historical rate during the pandemic until recently. And then they have, for those that own their home over many years, they have refinanced most of them at a much lower rate at 3 to 3.5%. So they are locked in. They're not going to sell their properties. There's no need to, right? At the worst case situation, if they're under stress, they can always rent their property out because the rental situation is at an all-time epic high in the rental market for obvious reasons. So most people are not in a stressful situation. But having said that, there's always people willing to sell for various life reasons. So it could be a probate, death of the homeowner, or it could be a divorce or disability situation, or people need to downsize. People need to cash in on their massive equity of their homes to buy all cash somewhere else in the U.S. or live overseas and retire at a high comfort using the equity of their home. So people still going to sell no matter what, but most people they're not going to sell. So today's housing market is very, very different. For people that think this could be a crash, I mean, I don't know. You're welcome to maybe provide your comment below on my video. So the big picture is there's still a historic low supply of inventory, and there are still high demand. Right now, the demand is not as high, obviously, because the interest rate has increased from 3 to 6 months, 3% to 6% in a matter of a few months earlier this year. And that's why it's causing a reset in the market. It's causing a slight correction, a crash, I don't know. But whenever supply is lower than demand, it's economics 101. Whenever demand are higher than supply, which is in this case, even as we speak right now, the real estate prices always increase in value. So again, for some of you that are predicting a crash for your own personal motivation reasons, if a crash would happen, which is highly unlikely, unless the worst case scenario, we're not going to go into that. So economics 101, when supply is lower than demand, then housing prices will continue to increase at probably not at a double or triple or quadruple digit appreciation, but perhaps single digit appreciation. Yes, that would be more reasonable. So again, if the housing value will decrease the next 1 to 2 years, that will be the first time in history where the demand exceeds supply and housing prices is decreasing. Will be the first time in history, which is, again, the probability of that happening, in my opinion, of a crash is slim to none. So if you want to call me out on it, please do so. Make a comment below. I'll be more than happy to answer it. But if your comments are unreasonable or outright belligerent, of course, I'm going to ignore your comments. All right? But it doesn't matter. I'm just stating my opinion based on 20 years of real estate consulting, based on helping real estate investors to buy investment properties throughout the country. For many years, thousands of investors that rely on my guidance and expertise and wisdom to recommend properties that can cash flow, achieve wealth in many markets in the U.S. All right, with that said, thank you so much. And let's talk over the Phoenix market, which from a high level, I do know quite a bit about it, although we're not promoting here actively in recent years for the reasons of the numbers. It just does not make sense. But for homeowners out there, yes, if this is the market you wish to pursue, to live, to own a home here, nothing wrong with that, right? As long as you have a long-term perspective. So with that in mind, let's go over the metrics of the Redfin weekly housing data. And again, we already went over the massive amount of equity you guys have gained, whether you are primary homeowners that bought during the pandemic or before the pandemic, whether you are real estate investors, have the wherewithal to purchase, during the pandemic before this year, you guys have achieved a massive windfall, 40, 50, 60, 80% growth in just a mere 2.5 years. So I know some of you guys are very nervous out there. You're thinking, wow, all the pandemic equity I have created in the past 2 years is going to go crash and burn. I mean, it's going to go away, right? I know there's a lot of nervous people out there, but no one knows about the future, but I don't think so. Would there be a slight reduction of prices this year, given the higher interest rate? Maybe, most likely. How much? We don't know, 5, 10%. I'm just guessing right now. It's too early to tell until we get more data. So with that in mind, let's go over the metrics. Let's get to the bottom of this, right? So right now, let's go over the current active listings. Active listing means overall how many market has been in, how many houses are in the market, total houses for the entire time, this year, 2022. So we're looking at, wow, am I looking at this correctly? There are 20,667 houses under the active listing, 50% higher year over year. By the way, I'm looking at this data, the Redfin data for the first time, right? So I'm giving you some spontaneous reaction and giving my overall years of experience. I'm going to give you my take on this, and some of you may disagree, which is fine. Yeah, we can agree to disagree. Feel free to subscribe to my channel. Feel free to make a comment down below on this video, and if I find your comment appropriate, it's not mean, then I may respond accordingly. All right. So this is quite a drastic trend. So 50% year over year in listings from last year, 2021, right? 20,000, right? At the beginning, before the interest rate skyrocketed from 3 to 6%. By the way, 5.5 to 6% is still a historical low interest rate. If you compare to the history of the interest rate back in 1980s, some of your perhaps your parents have gone through the 18% interest rate back in 1980s, right? And then in 1990s, they're like, 5 to 6 to 7% interest rate. And then past 20 years, the interest rate has been less than 5%. So, I wouldn't freak out over the 5.5 to 6% interest rate right now. Still a historical low, but the problem is the skyrocketing prices has really caused some home affordability, the lowest home affordability in the past 40 years. So a lot of people are priced out of the market for the reason I just stated. So look at the active listing early this year, February, March. There were a little bit over 11,000 listings, and in a mere 4 to 5 months later, until this month, August, we have doubled the listings from 11 to 20,000. This is mind-boggling. So what does this mean? Well, let's look at more data to come to a better conclusion. Don't jump the gun based on active listing. Now let's look at the new listing, right? New listing within the past month. Look at this. The new listing based on August 2022 is 2,134. That's 7% less than a year ago, year over year, new listings. Now, a mere couple of months ago, the new listings on that particular month in May to June was around 2,500. Now it's down to 2,100. So if this trend continues, this means that sellers are less and less of putting their house into the market, right? So let's follow this trend a little bit. And then the new listing median price. Let's look at the new listing median price when the seller are putting the house under initially to list their homes back in April to May. They listed an average median new list price of 500,000. Okay, now a few months later, the new listing price is reduced by approximately 20,000 to 479, right? So the new listing price has decreased slightly month over month and at almost 14% increase year over year from 2021. So we see price decreasing a few percentage points, nothing that jump over the top yet based on data so far. And then let's look at pending sales. Pending sales is 1,251, right? The pending sales has been lower, which is year over year, 34% lower than pending sales same time last year, 2021, in August. But then you look at back in this March or February, right? The pending sales is 1880. From 1880 to 1239, so we're seeing less and less pending sales. All right, so because the demand are not there, right? People cannot afford based on a higher interest rate, right? So that's a concern now. Then let's look at homes sold. Once again, is trending downward. The home sold is 1274, is 32% less homes sold year over year from August 2022 from August to August 2021, right? So those sales is 1,274 in August. Let's look at the peak this year. The close sale is 2,200, right? So from 2,200 to 1,200, we're talking very drastic decrease in homes sold. This means the demand has subsided and the seller are not selling as many homes just in the past few months. So that is something that remains to be seen as to what's going to happen. And new listing median price, once again, now you look at the peak median price in a Phoenix market, April to May is 500K. Now it's down to 479. We went over that, right? So there's like a 10% decrease in listing price, in median new listing price. That could mean that because the home affordability, because people cannot afford to buy as much home as they had before based on lower interest rate, so they have to buy lesser value homes these days, right? Since the interest rates have risen. So that could explain the 479,000. Not some of you are thinking the decrease in price from April to August. April is 500K, August is 479. You're thinking that 25,000 drop is a real market value drop? Not necessarily, right? Not as I explained before. It's too early to tell, but there's a little bit of sign this might be happening. All right, so keep that in mind. The median days on market. So now it's taking a little bit over a month to for the days on market on per house. So this means obviously there's no more multiple offers. If your homes are not priced correctly initially, then especially when the condition of your home is such that it's not ideal, that it'll sit in the market longer, that might partially explain the 34 days, median days on the market, right? And it has a big increase before the interest rate has risen, whereby before the median days to sell on the market is a mere 3 weeks. So pretty significant increase in just a few months. All right, now, having said that, now the next metrics, I call it, is could be defining. What I mean by that is that could mean something. So what I'm trying to say is let's look at price drops. Now, price drop is not necessarily actual price drops. Price drop means, let me tell you exactly what it means so you clearly understand what I'm saying. That this means the percent of active listings with price drops. Active listings with price drops. If somebody lists the price, if a seller lists the price at too high because they think that the demand has continued like it has been during the pandemic, they may list their price 10, 20% above what the market value dictates. So the sellers, maybe they not, perhaps they're not getting the memo, right? They don't understand that the demand has decreased and they're not going to get multiple offer. They're not going to get an over listing price. So upon consultation, hopefully with their competent realtors that are working with them, they may need to reduce the list price accordingly. How much is the reduction? We don't know yet. But one thing, what this trend tells me is a 14.6% of active listings with price drops. That's only 1 month. But if you combine it for longer, there's a lot. So that means the sellers are dropping the list price once, twice. So, and if the demand continues to subside, and if some sellers are desperate, they may actually reduce their price significantly. How much significantly? I don't know, 5, 10, 15, maybe even 20%. Is a case-by-case basis because the Phoenix metro is huge. There are several millions of population. Sometimes there are many sub-markets in Phoenix. There are many, smaller cities within the suburbs of Phoenix. There's so many. I'm not even going to care to name them. There's so many, right? Each neighborhood is different. Each market, each sub-market is different within the Phoenix metro area. And each street, each house is different. It's hard to do apple to apple comparison. Does that make sense? But this trend is really very troubling because earlier this year, the percent of actual listing drop from the initial list price is only like 2%. That's nothing. Now we reach like double digit. So this tells me that we may see a short-term market value actually dropping, right? Less demand out there, and some sellers, they still need to sell, even though, like I said, most sellers are sitting on their great 30-year fixed rate of 3 to 4% or even less. So they have no motivation to sell, especially if the current homeowners, if they were to sell on a 30-year fixed rate, they could lock it in, they have to pay 6%, a new rate, and their payments could be double. And the houses they can buy after they sell this original home could be worth more, right? So it's just numerically, it does not make sense to sell for many sellers. So what other things that we need to go talk about? Months of supply, right? Before I click this, months of supply means typically 5 to 6 months of supply with inventory creates a healthy, balanced market where the buyer and the seller have equal negotiation power, right? By the way, this kind of double-digit, triple digit, quadruple digit appreciation in the past few years in the Phoenix market or in any market for that reason are not sustainable. We cannot have this kind of appreciation. So at some point in time, we need to get back to a healthy market. And I suppose now, 2022 and even part of 2023, it'll be nice to see a balanced market when people can buy a home, when a first-time home buyer with a VA loan 0% down, with an FHA loan 3.5% down, have a chance to buy homes where they don't have to be outbid by somebody they buy with all cash like it has in recent years, in the past few years, right? So Monthly inventory, before I click this, usually 5 to 6 months. Anything less than that is still a seller's market, right? You agree? So let's click on the monthly supply, and here it is. The monthly supply is almost 17 weeks. If there are 4 weeks per month, 4 divided into 7, almost 17, is around 4 months. Currently, based on this short-term trend, but it's not long-term. Long-term, in the nation, there are still extreme historical low supply inventory. To the tune of we need about 1.5 million homes sold each year to achieve for the houses to be absorbed. Right now, we're only selling 500,000 projection of homes this year, which is 1/3. We're still only absorbing 1/3 of the ideal inventory in the market. So we have to sell 200% more homes this year before achieving a national equilibrium of housing inventory versus housing demand, right? So anyway, having said that, at least currently in this Phoenix market, the 4 month supply of inventory, so still a seller's market, but it's trending toward a balanced market where the buyer have more negotiation power. They and all these kind of things. So it's a good, healthy market, believe it or not, for those that can afford it, right? So this is a very significant trend. Let me see what else that we need to go on. Let's look at average sale to list ratio. This means based on the final list price and the offer being accepted, the actual sales price is it below the list price, at list price, or still above list price? And the answer is, no drum please. As you can see, it's below the final list price. The sales price is 0.98. So at least 2% below the final list price is the final contract price, which is a very significant, based on this big drop, right? This big vertical drop. Because before the interest rate rise from 3 to 6%, whatever, early this year, as you can see, April and May 2022, the average sale to list price is 1.02, at least 2% above list price asking back in early part of this year. So this trend line, the first 4 months of this year before the interest rate rise, we are still seeing multiple offers in the Phoenix market. People bidding above asking. Understand how the market changed just based on the interest rate, sudden rise of the interest rate. So this is very epic, right? Right. So I think as we conclude this presentation, anything else we need to go over? Active listing, let's go over everything. Days to close, we cover everything. Active listing, yes. Medium days on market. Did we cover medium days on market? No, the medium days market is 34 days, which is good. It's not frenzy. The house doesn't go into doesn't get an offer like we have in the past. 24 to 48 hours from the price from a house entering the market. Those days are gone. So 1 month of medium days on market is that's pretty like a pre-pandemic level situation. All right. So did I not cover any of the important metrics right here? I think I covered everything else. Okay, here's my recap. Here's my takeaway from this. Some of you are thinking, oh, what goes up must come down. Not necessarily, right? Some of you thinking there's a crash. I don't think so, because they're still very nationwide levels. They are still like 2 months supply of inventory nationwide, and 6 months is a balanced market. There's still some people predict like we are short around 4 million homes nationwide. Okay, new builders not building enough homes. In fact, they're pausing any more construction homes because they have to sell off whatever inventory that they have, fire sale, if you will, on new builds, at least for the short term. So, sellers are not selling, most of them, unless they want to sell. They have to sell based on the individual situation. So it's not going to be a crash because most people have a lot of equity of their homes. They set them on a low interest rate. If people want to sell, they sell at a good profit. Most people, right? And yeah, so there's anyway. So my take once again is it's going to be maybe a slight correction short term for the remaining of this year, maybe 10% drop, maybe 50% drop based on the lack of demand. But it's not going to be a crash because it just people, homes or you know is the main wealth vehicles people have. They're not going to get rid of it because they don't have to. So if the interest rate continue the way it is, 5.5%, 6%, we'll continue to see, continue resetting of the market. There will be no crash, no bubble. Yes, the recession technically may happen. The real estate recession, I mean, there's an overly overhyped world with housing recession. Doesn't matter. People need a place to live. There's a shortage of homes. The demand still could be strong, especially with the interest rate ultimately lowers, as long as the job market still continue to do well. Unemployment rate is very, very low still. There are more jobs available than there are available people to fill them. So the job market is still very healthy. And yeah, even if the technical recession, the housing market, the way it is right now, is not going to change that much. People need a place to live. The people that cannot afford to buy, which is quite a few, they're renting. So the rental market is extremely strong. We are hearing the rental, the rent is at a national epidemic crisis, meaning the skyrocketing of rents have increased double, triple, quadruple in some markets. I mean, skyrocketing of rents because there's not enough homes to rent, and the landlords are raising the prices because of inflation, all those kind of things. So really, the people that are in the worst position right now are renters. The renters that are on a low income, especially on a low fixed income, you're subject yourself to skyrocketing rents. You have no control. For people that have the ability to buy a home, even at this interest rate, that have the credit, that have the down payment, that have the cash reserves and they have an investment horizon. The primary home buyers out there, if they have an investment, if you're willing to stay in a house for 7 to 10 years, you'll be fine. Long term, 10-year mark, you will make money on your houses. All right. So do not be a flipper. Do not buy and sell within 24, 48 months because it's too speculative. So primary homeowners, still a good time to buy if your life situation dictate that you like the Phoenix metro market. Even at the medium price of homes, or is whatever the new price is, people that bought in the past few years in this Phoenix market, you have done very, very well. Right, you almost win this lottery. So medium price, Phoenix area is almost 500,000. So it's still very affordable if you compare to the neighboring California, right? So that's why so many Californians are buying primary homes here in the market, and the 500K is 50 or more percent less than the housing prices in California, especially in SoCal and NorCal, where I live, Northern California, Bay Area. So now one thing I say for mom and pop real estate investors, I don't want to buy a single family home as a rental. I do not recommend, because as you can see, if a median price of a single family home in Phoenix Metro is almost 500K, I mean, how much rent you need to collect in order to cash flow at 25% down payment based on 6% interest rate, for example? You need to use the 1% rule. 1% multiplied by 500K, you need to collect a monthly rent of around $5,000 in order for you to cash flow with 25% down payment to buy a single family home in Phoenix market. Okay, I will lower the numerical formula a little bit at 0.07%. Okay, let's make it realistic. 0.07% multiplied by the purchase price, that monthly gross rent should be the benchmark to achieve positive cash flow with 25% down payment. So 0.07% of 500,000, you need $3,500 monthly gross rent in order to achieve a cap rate of 5%, in order to achieve monthly positive cash flow of a couple of $100, right? At 6% mortgage interest rate. Are you gonna get that? If someone can pay you $3,500 rent, or to rent your $500,000 house, no, the number does not make sense. So I said again, back in 2019, when the median price of a single family home was $289, that might make sense 3 years ago. But hey, you did not pull the trigger 3 years ago when the prices were very, very low in the Phoenix market. At $289 at 2019, if the rent was $1,700, $1,800, yeah, maybe, but not 25% down payment. Even at 3.5% investment rate, you're not gonna cash flow. I'll tell you, I know the numbers, okay? I've been doing this for a very, very long time. So now the rent has skyrocketed, yes, from 1,700 to, let's say, 2,200, like $2,200 monthly gross rent, you know, from the 500K of a single family home rental private purchase, and you minus your monthly mortgage, your taxes, insurance, property management fee, and 5% vacancy factor, and 5% maintenance factor, you're not going to collect cash flow, okay? In order to cash flow at 500K, you need to put 60% down payment or 70% down payment, do the numbers, right? But if you pay all cash, if you pay $500,000 cash to buy this rental property, single family home 500K, yeah, you'll cash flow, but your return on investment and your cap rate and your yield will be minuscule at best. Besides, who has 500K to dump into buying one rental house to achieve $300 monthly cash flow? So you need to diversify your money and buy in a lower cost market, such as in the South and Southwest, in which our organization have those resources available for you. So thank you for attending. My name is SeeWing Yee from the University Network. Please subscribe to my channel. I will talk about many cities, many metro markets similar to this one for the foreseeable future. So follow my channel, click like if you like my this presentation, and also better yet, just log in your email to become a free member of our organization, the Real Estate Network, and you will receive monthly free newsletters on actual real estate opportunities from the recent market that we have connection with, the network of market we have in specific markets, off-market cash flow properties, all vetted, done for you, vetted, and in-house property management, turnkey, passive, out-of-state, successful investing, buying cash flow properties with 25% down payment, even with 6%, you can cash flow, albeit slightly for the time being, in those excellent markets in the South and Southeast of the US. Okay, thank you so much for attending to the SeeWing Yee. Have a nice day. I'll see you on the next video on another market. So please comment below of what you think of this presentation and what other market you want me to present, and I'll be more than happy to make the appropriate presentation similar to the one I just did here at the Phoenix. Hot, fast-growing, long-term market. Phoenix could do very well long-term because it's a sun belt. There's no state income tax, I think, and prices are still affordable compared to other markets, especially in California, and a lot of migration, people from everywhere coming to this hot job market, population growth market, good amenities, good lifestyle, all that stuff that you have in this particular Phoenix metro. Thank you so much. Have a nice day. Bye-bye.